Good afternoon, everyone. Welcome to another one of our Wednesday market reviews. My name is Stockdarts, and we're going to do the typical thing we do on Wednesdays, which is cover the four major market ETFs. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those, we'll take a quick look at the US dollar, and then look at a couple crosses with the US dollar, and then look at gold, silver, and oil. And once we finish that, we'll move on to chart requests. If anyone in here has a chart request, feel free to type it in there. I'd love to analyze the charts that you guys are looking at and that you guys are trading. If you like what you see here, you can follow me on Twitter at stockdarts or find me on YouTube at stockdarts, where I usually put reposts of the Wednesday market review as well as any videos I might come up with. And you can visit me at patreon.com/stockdarts, where I post blog content weekly, usually watch list ideas, trade ideas, stuff of that nature. And that's typically where you're going to find more of my content if you're looking for more content, if you like what you see here. Other than that, let's go ahead and get started. The first thing we're going to do is take a look at the S&P 500, looking at the ETF SPY. Alright, so here's a look at the S&P 500. As you can imagine, things are looking pretty good considering we are right up against all-time highs. We've had a very nice week and a half. I mentioned last week that things were looking like we were going to break out, and so far that is the case. Now, as far as the S&P 500 is concerned, I would say all systems are go for a full launch and for a big rally. I'm still a little bit leery about IWM, and we'll get to that in a second. Those of you that are regulars know that we have been watching all four of the major ETFs, and while three of them have looked pretty strong, the small caps of IWM still are a little bit behind and lagging a bit, and definitely showing some relative weakness. And until we see that totally change, I can't get on board behind a full-fledged rally. But I do think that right now the market is very bullish, and we should be looking to trade with an upwards bias, and we should be looking to trade to the long side. Now, as far as the extent of the rally, what can we expect? Well, I think at the moment things are looking like we could get a very strong rally. I still harbor a couple of doubts on just how strong this rally can be. But I'm going to save that for when we get to IWM. But as far as, like I said, if we're looking at the S&P 500 in a vacuum, well, there's nothing negative here, and it looks like we're setting up for a pretty strong rally to the upside. I'm going to go take a look at the weekly chart real quick and give you guys a broader term look at what's going on here. And you can see that we've spent, since about 2018 to now, we've basically spent it trading sideways. And as we've approached the end of this year, you'll notice that we started to consolidate and really start to push ahead and forge through the ceiling of that price range and start to print new highs. And we are now starting to leave that area, right? So we had one consolidation, and then as we approached the end of it, we had a secondary consolidation, right? And now we're leaving that behind, and we're starting to move forward. Now, because of the way IWM is behaving, there are two things that could come into play here. One is that we spend some time sort of stair-stepping higher, and if IWM doesn't participate in the current rally, then I expect us to sort of stair-step and start probing higher as we wait for IWM to get its act together. If IWM gets its act together and starts rallying, then I don't think we're going to stair-step. I think we're actually going to launch very similar to what we did at the end of 2017, or actually end of 2016 and the beginning of 2017, where we went straight up for almost a full year. And I think we have the potential for that kind of a rally. I don't think that this is just I don't think that we're looking at a move similar to what we've had over the last couple of months, where we're just sort of peaking up to new highs and then coming right back down. I think there is potential for a strong rally, very reminiscent of what we saw in 2017, but we need IWM behind that. So, as I said, when we get to IWM, I'll explain what I'm seeing there and why I think that I still harbor a little bit of doubt with what we're seeing. But as far as the S&P 500 is concerned, I think we're already well on our way towards establishing a run very similar to 2017. So right now things are actually very, very bullish as far as what we're seeing on the S&P 500 and what we're seeing on the NASDAQ as well. And I don't know that you'll hear this a lot from a lot of people on social media, and particularly in regular media. But as far as just judging the price action right now, there is nothing negative here that would lead us to believe that we're ready to top out and we're ready to roll over. And the good thing about this is that we are now in enough of a bullish stance where we can get pretty aggressive. And if we're wrong, and if the market does start to roll over, well, we have a lot of points that we can look at as these little warning signals that'll tell us to go ahead and start to change our stance. And the first thing we can look at right now is this level around 302, which we're actually quite a bit ahead of already. If we fall back in price, and there's always a chance that we pull back. You'll notice we've been consolidating ever since we broke out. You could look at the volume dropping as we sort of trade sideways. If for whatever reason we run into more distribution and more supply than we're ready to plow through, and we do pull back in the market, well, we already have a couple little soft spots for a nice little landing here, whether it's the 20-period moving average or this area right around 302 to 303. And if we do pull back, as long as we stay above that, I think, again, we're still in a very bullish place where we should be looking to take advantage of bullish momentum to the upside. And to tell you the truth, it would almost be welcome if we pull back a bit and reset some charts and gave us better risk-reward. So that would be the first level that we would kind of concern ourselves with. If we lost at 303, then that would be the warning signal to tell us, well, maybe we shouldn't be uber bullish here. Maybe we should kind of back off. Maybe we should look at continuing to take the range-bound trades that we've been looking at over the last 3 or 4 months. Now, if we did fall below that, well, we've got the 50-period moving just below it, climbing up to meet price. And honestly, I don't expect us to lose this price point between now and, say, the next week, 2 weeks at the very least. So even if we do get some selling in the markets, I don't expect us to lose this level. But if we do lose that level, well, we have another strong level right below it at around 295, and that would be sort of the second level of warning, right? So that would maybe be where we start to really worry about what's going on with the market and whether we need to rein in our risk or close positions or raise cash levels and figure out where we want to go next. And then if we do lose that level, we've got the 200 period just below it coming up to meet it. And then finally we have the real line in the sand, which is way down here around 280. And I think that's at the point where we'd start to worry about bear market or market top or anything of that nature. And I think, again, that's pretty far off right now and not a level that we need to concern ourselves with in the short term, but something that we need to watch in the long term in case price, for whatever reason, does take a downturn. Well, we've got all these different levels we could look at before we really have to get nervous and worry about the market. And to tell you the truth, even if we come down to 280, as far as a longer term level, it's still not that bad, right? If you take a look at what the market has done over the last, say, 5 years, with lows down here around 184 and where we stand now around 309, even if we came down to 280, in the long term, is that really anything negative? So as far as those of you that have IRAs or retirement accounts and you're worried about the health of the market and what you could do, well, at the moment there's nothing wrong, there's nothing negative, and the market is going to have to go up and down. And so even if it starts to come down to these levels, that's still, in the overall scheme of things, in the longer term time frame, just regular back and forth action, right? So there's a long way to go before we really have to worry about a market that's rolling over or crashing or overly negative. Now, for traders, I think that's an important line, right? Because as far as swing trading or trading in the shorter term time frames, you want to match what you're doing with what the market's doing. And that's a big reason we do these Wednesday market reviews, is to try to analyze where we stand in the market and what type of environment we're in. And for the last couple of years, we've been trading in a mostly neutral environment. Now, it has had a bullish inclination to it, or a bullish slant. So for the most part, what I've done over the last couple of years is I've been taking range-bound strategies, but looking more at the buy side than the sell side, because for the most part, the market has continued to climb slowly higher, even if it's been range-bound for the last couple of years. And as I said, we're starting to emerge from that, and we're starting to really look like we want to push it forward. And if that's the case, then we need to start looking more at bullish momentum strategies and less at bullish range-bound strategies. So that's kind of where we stand. Now, to the upside, there's no real target, right? Because we're at all-time highs. I can't really point out any recent resistance levels besides yesterday's highs. And as long as we continue to probe higher, the market's going to continue to move forward. Now, one thing I do want to point out, the risk-reward at the moment is not the greatest for a long play, at least if you're looking at a chart of the S&P 500, or if you're looking at any kind of chart that's behaving the same. Now, as I've gone through a bunch of other charts, as I typically screen through a few hundred charts a day, at the very least, looking for possible trades. One thing I've noticed is that there's a lot of charts that aren't doing the same thing as the S&P 500 or the Nasdaq or the Dow Jones. Uh, there's a lot of charts that are going up and mimicking this, but there are a lot of charts that are also consolidating. There's a lot of charts that are breaking down. You normally don't see that in a strong market. When you see something, and what I mean by that, not a strong market like this, but what I mean is a really strong market like what we saw in 2017, right? So to go back to the weekly chart, when the market is climbing like this, you're going to have over half of the charts, probably like 60-70% of the market charts, are going to be in the same sort of pattern as what the overall markets are doing. Whether that's a market that's climbing up or whether it's a market that's breaking down. So for instance, at the end of last year when the market was starting to really tank and start to threaten a real strong breakdown or crash, a lot of charts were mimicking this and printing similar patterns. They might not have been the same exact pattern, but there was definitely the same sort of idea where they would pull back, then trade sideways, and then kind of crash down more. We're not really seeing that right now, right? So that's one warning signal that maybe the market's not ready to really rip yet, because there's a lot of charts that aren't exactly copying what the market's doing. But that also gives us the opportunity to find charts that have better risk reward compared to what we're seeing in the S&P 500. So if the market wants to climb higher, rather than chase the price action on a name that's doing the same thing, look for a name that either has already consolidated and is emerging from that consolidation, or has pulled back to support and is setting up for a bounce trade. And I think that's really the way we need to approach trading for the next week or two, until we see the market align itself a little bit better, and more importantly, see IWM align itself better with what the market's doing, in which case then we'll start to see stocks move in unison and start to print similar patterns. And when we see that, then we'll know that we're really ready to truly break out and really ramp up the price action. But for now, I think, again, we're very bullish. I don't think that there's anything negative I could point out about the market, other than picking little things. And it's more of a matter of us remaining disciplined and finding trades that give us good risk reward or good timing setups as the market starts to try to probe higher and start to push further up ahead. Now, we look at the Nasdaq. If we look at the Nasdaq, we'll see that we are once again doing the same thing as the S&P 500. Ray, you're not going to get email notices from Twitch unless I think if you follow me, it'll email you once I go live. But we're not on the same platform as before. We're not on the Citrix GoToWebinar, so it's not going to send you emails telling you about this. You have to know. You've been following me for years now, so you know it's always Wednesdays at 12:30. If I decide to do a stream at some point, it should email you as long as you follow me on here. But we've switched to a different platform, so you're not going to get those emails like before, okay? Good to see you in here. And again, those other viewers that are in here, welcome as well. Feel free to ask me anything you want in the chat. I love interacting with you guys, and I love seeing what you guys are looking at. So if you guys have any charts you want me to look at, feel free to type it into the chat, and I'll get to them as soon as we cover the major markets and a few commodities, okay? So if we look at the Nasdaq, it's doing the same thing as the S&P 500. Printed new all-time highs yesterday, right there again. You can see volume declining as we consolidate. We're so slowly inching our way upwards, and you don't always want to see this, where you slowly climb on declining volume. That has always like sort of a hint of a short squeeze to it, or of just price action getting extended. And a lot of times what happens off of that is you get a pullback. So that, if I want to go ahead and nitpick a little bit and really kind of try to find any negative, I can say that. But overall, again, it's a very strong market, and it's very bullish. And I think that's the easiest thing we can look at is we're in a strong market. So we should not be nervous about this market right now. We should be looking at playing it to the bullish side, and we should be looking to take advantage of what appears to be some pretty strong bullish momentum. Now, very similar to the S&P 500, we're well above what should be the first level of support, which is this 195 area. Those were the highs from the time we spent consolidating from about June or July to late October. And once we broke past that, you can see we've just kind of climbed straight up. And at some point, we probably will come back and retest it. But right now, again, this is setting up for if we do pull back, we've got a nice little soft landing spot here at the 20-period moving average or 195. And I think as long as we stay above 195, things are strong enough that we should just look at buying and not be too worried about a price pullback. If we do lose 195, if for whatever reason some news comes out, whether it's more problems with China or something with the Fed, and we drop further, well, I think we've got another really good support zone here around 188 to 187, and I think that's kind of the key in the intermediate term. The 200-period moving average would be coming up to meet that, and I don't expect us to fall back below the 200-period from here to the end of the year. So I think overall, that would probably be, to me, the worst case scenario, is unless things change drastically. And again, that's the whole point, right? We try to figure out what's going to happen, and we get a plan of attack according to what's going to happen, right? So as long as we stay above 195, I think things are extremely bullish, and we're looking to take off and trade much higher. If we do pull back and come down to about 189 area, as long as we stay above 189, I think things are still bullish. We just needed more time to set up for a strong bounce. We needed more time for IWM to get its act together and join the rest of the indices. Now, if we do lose that and we start to head all the way down here to the 177, then that's when we start to get nervous, and that's when we start to assess where we are and where we stand in the market and what we want to do next, right? So I think that's the ultimate line in the sand, really, as far as swing trading is concerned, is anything around 178. Now, at that point, we'd be well below the 200-period moving average, so I'd be pretty nervous at this spot, and I'd be looking at a lot more bearish strategies, or at the very least range-bound strategies, and taking advantage of a market that's chopping, especially because that would be a failed breakout, and that would probably not be a good sign for the bulls if we had this strong breakout and then we ultimately failed it, and not only failed it to drop back below 195, but to lose this other level that we've kind of left behind a couple of times already. And again, the reason this 187 to 188 level is important is because that was the ceiling of the price action throughout the last couple of years, and we only started to really push through it over the last few months. And if we kind of lost our recent highs and then came back and lost those highs as well, that would show that the bulls have lost control of the market, and that the market is looking to figure out where the bulls or the buyers are willing to kind of step right back in. And if it wasn't 178, then more likely than not, we're probably going to head all the way back down to the 150s or 160s. So those are the key areas that we need to watch right now. It's this 187 to 188, and then below that 178. But I think in the short term, we should probably hold above 195, and as long as we do hold above 195, I think all signs are pointing up, and I think we should be looking to trade momentum higher, and we should be looking to be bullish rather than thinking this is a market top or being nervous about where the market is. I think right now is not the time to be nervous. Right now is the time to be looking for opportunities to take advantage of what could be some strong momentum to the upside. Now, that being said, you don't want to get too reckless and just chase price action higher, because you still want to make sure that you maintain the good risk-reward discipline, and you take trades that give you the best chances of success. Because, as traders, you can't really predict whether the market's going to go up or down. What you can control is what your entry point and your exit point are, right? And so that's the only real, and actually the exit point, you can't even really control that. You can only control the decision you make to get out. But the one thing you can control is when you enter. And you want to make sure that you do that in a spot that is advantageous to you and your trading style. So make sure that you keep that in mind, and that you don't chase the price action higher, that you don't let this fear of missing out get in your way. And I do, as an aside here, to go back to the weekly chart, I think that in general there are two types of fears when you're trading in the stock market, or in any equity really. And that is the fear of loss and the fear of missing out. And most traders associate fear when they're talking about fear and greed in the market. They basically relate fear to this idea of losing trades and fear of losing money. But in truth, the more insidious and the more dangerous fear is the fear of missing out. And I find that that's the fear that gets more traders into trouble. Is this fear that they're missing the big move, or they're missing the trade that they knew was going to move, quote unquote, right? And What happened last time was, and this has happened a few times. I've been doing these sorts of videos, and I've been mentoring traders for a long time now, and I found that in general, traders seem to mess up more when they have the fear of missing out. So when you have a market like we did in 2013 to 2016, that was such an easy market to trade. The market basically erased almost any mistake a trader would make. But I still had a lot of traders that were maybe break even, maybe even still down during those times. And the reason for that was because they had the fear of missing trades, and they kept chasing price action higher, and they kept getting in at the wrong time because they did not want to miss the big move. And the truth is that the market is always going to give you chances to re-enter. And what you want to make sure is that you don't lose your discipline and you don't fall into this idea of making mistakes because you're worried that you're going to miss the next big trade, or that you're missing out on what's happening, right? So a lot of traders right now are probably jumping in at highs and piling in, and as you can see, volume's declining, but there's still traders that are kind of coming in as others take profits because they don't want to miss out on this move. And the truth is they already missed this move. And what they need to do now is make sure that they are disciplined and waiting for the right opportunity to go ahead and get into their trades. And so I think that's really the key right now, is to try to take advantage of this bullish momentum, but in a way that's responsible and disciplined. And that means looking for trades that are either ahead of the curve and have already broken out and come back and retested the breakout, or are slightly lagging behind and are still consolidating or trading in bull flags, and setting up for moves that are a little bit easier to pinpoint the right entry point, as opposed to what we're seeing here on the NASDAQ. Okay, now if we look at the Dow Jones, we can see something very similar again. We have a stock that printed new all-time highs yesterday and is kind of right up against the edge of it again. And once again, above the highs from this consolidation time that we spent over the summer, from July to late October. And overall, it's the same basic analysis I had with the S&P 500 and the NASDAQ. Now, you'll notice we're not that far away from it. So the Dow Jones has been relatively weak recently. I don't think it's anything to concern ourselves with. Typically, the only time I'm worried about the Dow Jones' relative strength or weakness is when it's leading, at which point then you need to wonder if it's leading because the market is nervous, because there's less components in here, and they tend to be more stable stocks that traders gravitate towards in times of distress. So typically the Dow Jones will not lead during a strong bull market. It's not always the case. Sometimes it does, but more often than not, it's just mimicking what the S&P 500 and the NASDAQ do. And that's kind of what it's doing right now. It's the same reference points. We've got this area around 273 and the 20-pair moving average coming up to meet it as our first spot for a pullback. And if we do pull back, that's the level that I would expect to hold, at least initially, and would set up for a really good bounce trade for those that are waiting for a pullback and waiting for a little bit better value area before going and trying to get long. If we fall below that, well, the next key area and the kind of the important line in the sand for short to intermediate term swing trading is this 265 to 266 area. The 200-pair moving average will likely be there, and as long as we hold above that, I think things are still pretty bullish, even if it's more along the lines of the same bullishness we've seen recently. And then if we lost that, well, then we'd probably head down to 254. At that point, we'd be well below the 200-pair moving average, and things would be decidedly different at that point. And if we came all the way down to 254, we probably could look at a bounce trade, but at that point, we'd be a little bit more nervous about what the market is doing, because again, it would indicate that we failed a pretty critical breakout, and that we likely failed even this major consolidation that we spent the last few months in. So that's really kind of an important area, but we're not really concerning ourselves with that yet. That's just a contingency plan in case for whatever reason some really bad news comes in and we head down to those levels. But for now, we can look at basically 273 as the initial point where we could look at buying the dip. And if we came down to 266, we could probably look at buying the dip there, but that would be a little bit different. We'd be looking at more range-bound plays, and we'd probably do it a little bit more cautiously than how we should trade around 273. Now, that's really all I want to say about the Dow Jones. It's the same analysis as the S&P 500 and the NASDAQ. Overall, it's bullish, and I don't think that there's much negative that I could point out here. But we do have IWM, and I think this is the one real index or ETF right now that I'm still kind of nervous about, and that is because if we take a look at what IWM has done this year, it has really struggled to break through this 158 to 159 range. And every time that we failed to break through that, we've ended up coming all the way back down to lows. You can see we kind of came up here. This is the one time we didn't, I guess, was back in March. We pulled back and came down to about 148, and then we kind of came up. And this failed breakout was a major turning point in the price action for the year. And we had a strong move down to the downside. And that was probably the most substantial pullback in the overall markets. And then recently, IWM again has tried to break out through that level a few times and failed. And we actually were able to break out this time, but we've kind of come back in, and you can see we're printing a bull flag as we consolidate around these levels. And I think at this point it's still up in the air as to whether IWM is going to be able to break out or not. And this is a very critical spot. Ray, you're still holding your call spread on that. Still trying to collect your premium. You have a couple days to go. It's going to be pretty close. And if you have good profit on it, well, you'd probably about break even on it. But if you have profit on it, you might want to look at taking it. But it's still up in the air. And I think this is as much of a coin flip as you could get on a trade like this. You can see it's been hovering right around that level. It's trying to break out, but at the same time, it's failing. Right? If we look at it, we just zoom in. You can see that as it tries to break out, you can see all the selling pressure, right? You can see all the wicks above it. You can see the red candles coming in. And as it starts to fall back below it, you can see the buyers try to step in and try to support it. So there's a big battle going on here. And I think that this is the chart to watch if you really want to get bullish in the market. And it's what I've been eyeballing all week, is trying to see if IWM can break past that. I think if IWM can break past this bull flag, can get back above 160, then it's all systems go. And I think that we're going to get a very strong rally into the holidays and through the close of the year. And I think that if we can break past that, we should get a really strong momentum to the upside. Now, if IWM falters and cannot break through and comes back down into the mid-150s, well, then we have to really figure out what's going on, right? And I think that as long as IWM doesn't come back to lows, what we're probably going to see is we're going to see the other indices, the NASDAQ, the S&P 500, and the Dow Jones, slowly glide back and test some of these prior levels we were looking at. So probably around the 302 area on the S&P 500, and kind of confirm their breakouts. So if IWM cannot push forward, then we probably do that stair-stepping thing where we just kind of consolidate and try to hold above the range that we spent the last 2 or 3 months in. If IWM can break out, then I think the rest of the indices are going to break out as well and start forging upwards. If IWM fails and comes all the way back down, then the other indices are likely going to fail their first level of support and look at that second level that we were looking at. That's the more important line in the sand. So for now, I think IWM is the chart to watch to really figure out what kind of environment we're in and what kind of price action to expect. If we break out again and get past about 159 to 160, then the market should really start to move forward. If we stay stuck in this range or pull back just a little bit, then we're probably going to stay in that sort of stair-stepping scenario where we just sort of inch higher. And then if we fall below it, then that's when we start to reassess where we stand in the market. Even if we fall back down to the 200, it shouldn't be too bad, but at this point, I really expect IWM to break out. It's tried already several times this year, and if it can't do it again, then that's a pretty bad sign. And it shows that the bulls don't have enough really clout to push the market higher. So that's the key. I think overall, the market is bullish, and despite the fact that IWM is still acting a little bit weakly, I think that we're still in a strong market, and whether it's a strong market that's going to rally straight up or it's a market that's going to continue to sort of inch higher is up for debate, but I think overall it's a strong market, and I don't think that there's enough negatives for us to worry about a market top. I think at this point the bearish scenario or the more negative scenario is still a market that's range bound at highs and trying to probe higher. So overall it's still bullish, and I think it's still a market that wants to climb higher. Alright, if we look at the US dollar, we'll see that as an aggregate it's bounced pretty strongly over the last couple of weeks now, and this has put some pressure on gold and silver, and overall, again, this is, I think, a function of the euro more than anything else. If we take a look at the euro US dollar cross, now keep in mind this chart is in euros, so down is good for the US dollar and up would be good for the euro. You can see that the euro struggled to hold this level around 112 to 110.70 and kind of broke down. And it's coming down here, and it's reaching the point now where it's retesting this trend shift that it had in October. Now, this is important because the euro has been really struggling versus the US dollar, and it finally had a turnaround and established what should be a bottom. And as it tried to build upon that, it faltered and failed, and that's pretty standard behavior. It's pretty hard to get a V-bottom like this, especially on currencies, unless there's major news. More likely than not, what happens when you break a trend is eventually you shift towards a neutral base and you start to build out a strong base. And you can see the euro had a trend that it broke, and then it actually tried to establish a base and failed and broke down. So we're at that point again where it's has to either establish a sideways trend or it's going to continue breaking down and it's going to start a new breakdown. I think it's going to bounce here soon. I think it's going to attempt to establish this base again, and whether it does ultimately break down, I think it will try to try to establish a bottom here again before it does break down. So I expect the euro to bounce sometime soon, but at the moment we're not getting any real clear signals for that, and so that's showing that the US dollar is still gaining some strength here, but I think it's going to change shortly. Now, if we look at the US dollar versus the Canadian, we can see that the US dollar has gained strength as well on that, but that was after a pretty big breakdown. And it's starting to come up into resistance at the 200 per moving average, and then above it around 133. So there's a little bit more room of upside to the US dollar's current move, but it should run up into some resistance in the near term, at which point the dollar will probably struggle to move past that. You can see that this 133 area has been a pretty strong level of resistance over the last 4 or 5 months, and as it comes up to that level, it should struggle again. And then finally, if we look at the US versus the yen, again, you can see the US dollar has built up a little bit of a move, but interestingly enough, over the last 3 or 4 days, while it's been strong against the other two currencies, it's been weak against the yen. And again, I think this is more a function of yen weakness and yen strength over the last 2 or 3 days. But I think overall this is a different move compared to the other two, and I think it's based more off of the yen. And this is the one chart that looks a little bit different. The US dollar looks like it's really starting to build up strength versus the yen, and I think at this point it looks like it wants to rally here and move higher. We had a nice inverse head and shoulders. You take a look at it from here, from 1086, we came down, came up and tested and failed, and then came down and established a nice bottom, and then came up and then came down and tested that shoulder again, and then came up, and right now we're kind of holding up above that neckline, again ready to rally. So I think overall, if we could find any of you guys that trade forex or likes to trade currency markets, if we get a nice reversal signal here and a show of support, then this is probably a good long play, looking for a move not only up to back to its recent highs around 109.40, but likely a move up into the 110s and 111s. So what does that mean really? Well, I see some cross currents here. The US dollar is starting to get a little tired versus the euro and versus the Canadian, but it looks like it's starting to pick up strength versus the yen. So overall, I think it's just the US dollar that's trying to figure out where it wants to go. And that likely means that as far as the UUP index is concerned, it's going to continue to just sort of establish this range here between about 2650 and probably the low 27s. And ultimately, that means that gold and silver are kind of stuck in limbo as they wait for the US dollar to figure out what it wants to do. You can see GLD lost a pretty critical level here around 140 and actually broke down even below 138. So I think overall this recent dollar strength has hit gold pretty good and silver pretty well, and they've started to struggle. Now there is support forming now and a little bit below where the price action is, so there's a chance that it bounces once we see the US dollar top out versus those currency crosses we were looking at. We look at SLV, same sort of thing. And if you remember last week and the week before when we were looking at it, I thought the better idea was to look at gold miners, and I thought that they've been holding up a little bit better than what gold and silver have been doing. But overall, they're starting to come up into some levels of support as well. And you can see we found some support coming in on the miners, and they started to bounce a little bit. But overall, they're just stuck in a range right now, and they're still kind of struggling here. One of the charts we like to look at is actually breaking out, KL. It's really been struggling at the apex of this triangle, but it is starting to move upwards a little bit. So the gold miners are still holding up despite the fact that gold prices have been a little bit depressed recently. And if the US dollar starts to fade back a bit and take some of that pressure off of gold and silver, then some of these miners might continue to move upwards, despite the fact that we're seeing weakness in gold and in silver. So that's still an area we could watch, and that's not a trade we need to abandon yet. But at this point, my trigger finger is on pretty quick on it. Ray, you are losing on your gold calls. See, that's the problem sometimes when you take options trades and when you take trades on these XXX funds. Wait, you weren't on NUGT. Which one were you on? You were on JNUG, right? Because you were the junior. And that's the problem you get sometimes with these triple leverage funds, or with when you're using options, is if you didn't time it correctly, then you lose just because of the decay of the instrument that you're picking, right? And I think that's the problem with these triple leverage funds, and that's the problem sometimes with options. Those of you that know me know I use options quite a bit when I'm trading, but a lot of the times I take the opposite side and I sell the premium because options are a naturally decaying instrument, and more often than not, if you're buying premium all the time, if you don't have impeccable timing, you're going to struggle because trading's hard enough just picking a direction, but now you're adding a time factor into it, and that makes it more difficult to succeed. And not saying it sometimes it is right to buy it, but you have to be real good about your timing, and you have to make sure that you understand the risks in place. So you still have time on some of those, especially those December ones. But as you can see, it starts to decay and you start to lose value, unless you get the move in your direction. But I think overall there's still time for these to work. And in particular, I think that some of these that I was looking at, like KL and TRX, are still holding up at okay levels, and they could still provide us with a good bounce if we can get some relief in gold and silver. Finally, the only other instrument we want to look at is oil. And here's a look at crude. And crude is trying to bounce. You can see it's really pushing up. Again, we've got a little bit of a war here between the buyers and the sellers here as we approach the 200-pair moving average. You can see the 200-pair moving average really holding down price, but underneath it, there's a lot of buying signals here, right? And so I think that oil is likely going to break past 57 or 58 and try to climb up to 60. But there's always a chance it fails. But I think it's more likely than not going to push past this level and come up. Now, the problem here is that the risk reward's not that great, but I do think that some oil names are shaping up for okay plays. And if we can get a push past this 200 period and past some of these wicks, some of these oil names that we like to look at might be able to push past that and break through there. All right, so that's oil, gold, and silver. I think there are still some plays with oil, gold, and silver. I think that overall, if we look at the market as a whole, there's a lot of different areas of it that we could look at playing to the bullish side right now, because, again, the market, I think, is pretty bullish. We have some time left. Those of you that are in here, if you have a chart you want me to look at, feel free to type it in now. There's really not much else for me to share other than what I've already shared. So we have some time. If not, then we can call it already. But I'd like to see if you guys have some charts that you're looking at. I'd love to see and analyze what you guys are trying to trade. So Ray, you said you sold calls on Apple. Okay, so walk me through this, Ray, because I don't think I like that trade too much either. So you sold the 262 and you bought the 265. Is that correct? So the problem I have with that is that I don't like to short something just because it's up, and I definitely don't like to add to it just because I'm wrong. Um, Now, the problem here is that Apple's on a really strong run, and they're one of the leaders right now in the market, and they tend to do well in the holidays as well. But that's not really the issue. The issue here is that I think a lot of times traders look at a stock that's up and they're like, well, this can't continue, so I'm going to short it. And the truth is that a lot of times they could squeeze for a lot longer and a lot higher than you can really expect or anticipate. Um, and in the market that we're in right now, like I said, one of the things that I like to do during these Wednesday market reviews, or really the reason that we do these, is to analyze the market and to try to understand what market we're in. And right now, as I kind of spent the last hour talking about, we're in a really bullish market, right? Um, when you're in a bullish market like that, you don't want to be taking short trades. And if you do take a short trade, you have to be shorting weakness. You don't want to short strength. You don't want to short a stock just because it's up. Because the truth is, even if this thing is ready for a pullback, it might just be a little it might just be a little tight bull flag, or it might just trade sideways like it did here, right? So we had this big move, and then it traded sideways for 3 days, and then it started climbing up again, or something like this, right? Where traders are like, well, it's up too much, it should short, and then it maybe has one pullback, or even this was a pullback of 2 days, and then it just took off again off of the earnings, and there's just it's too hard to try to take a trade a counter trend trade against this. Every book you've ever read always says follow the trend, and while I'm not 100% behind that, I think counter trend trading is a thing, especially when you're doing mean reversion stuff. But I think in general, when you have a market this strong and you have a stock that's this strong, there's just other targets that are better off for the shorts. Like your trades with gold last week, I think were good, and I think even your counter trend trade in IWM was fine because you're trading against this is a major ceiling, and it's a level that IWM has failed several times. So I can understand taking the short there. Even though I wasn't going to take it, but I can understand taking that. I can understand taking the long plays, but I think a trade like Apple, trying to short that, I don't think that's I think that this is just, you're basically just throwing money away because the chances of it succeeding are very slim, and even if it does succeed, the chances of you actually being able to take profits at the right time are difficult because it's so bullish that even if it comes down to where you want it to be, it might do it so quickly that you kind of hesitate and don't take your profits. And I think that's the key here is that before we were talking about the types of fear in the market, there's also the types of capital you want to protect. And one of them is your money, but the other is your psychological capital. And when you take trades like this, it starts to eat away at your confidence because you make mistakes, and then even if it does pull back to 252 or 262, and then it bounces again, if you fail to take it, then you start to beat yourself up over missing that as well. Same as what IWM is doing to you now, right? So that's the other thing you want to be careful about when you take some of these trades, or when you're trying to figure out whether you want to take a trade or not. You have to ask yourself a few questions, and one of them you have to ask yourself is this going to be a difficult trade for me to get in and out psychologically? Are these clear-cut decisions, or are these decisions that are going to haunt me while I try to figure out whether I should take it or not? And I think that that's pretty important when you're trying to assess, trying to look at whether you want to take a trade or not. So, for instance, since no one else seems to have a chart request, here's a chart that I was looking at as a possible entry, and it hasn't really materialized. And it's not a good trade. It's not one of these trades that looks like a great trade when you look at it. But what I want to point out is the clear-cut signals that protect me psychologically. It's a trade that I know my decisions. They're made ahead of time. Does it break this descending trend line? If it doesn't, then I don't enter the trade. I don't have to second guess myself and try to figure out whether I want to get in or not. The only way I'm going to get in is if this thing shows me bullish momentum, and the only way it's going to show me bullish momentum is by breaking this trend line. On the same side, if I had entered the trade and it came back down, well, my decision to get out is very simple. I already have the support level outlined here at 350, and if it broke below that level, then I'd know to get out. And it's very clear cut. And on top of that, even my decisions to get out are pretty clear. I have a decision to scale out at 370 and another decision in the 385 to 4 range. So everything is clear cut. There's not a lot of psychological or emotional second guessing that I have to make, because the trade, everything is dictated by the trend lines that I drew and the theory or the thought process behind why I would take or not take this trade. And in the end, I haven't taken this trade, and I might not take this trade. But if I did take it, all the decisions are clear cut, and every decision is made ahead of time, and I don't have to think too hard about it. When you take a trade like this Apple trade, you're just kind of jumping in and kind of saying, well, I'm shorting it because I think it's going to go down. But do you have a clear cut signal telling you that you're wrong? Do you have a clear cut signal telling you when you're right? It's not that difficult. You just took a spread and you're hoping that it works in your favor. And those types of trades tend to put you in a rut, and that's how traders get into slumps, because they're taking trades that aren't clear cut and don't give them clear cut signals as to how they want to go ahead and navigate the trade once they're in. And once you're in a trade, no matter how good of a trader you are, you become more emotionally attached to it, and you start to make decisions based off of those emotions if you didn't already have a plan outlined, or if you don't have logical setups for your exits. So this particular case, I mean, yeah, I think you know this already, but I don't know that I agree with that trade. I think that was a tough trade to take, and probably one that you kind of got emotionally into. Now IWM's different. I think if you sell premium like that and it's hovering right around the breakpoints, sometimes you got to let it play out and have faith in the levels that you chose to begin with. But yeah, so that's my thoughts on Apple. So and the rest of you guys that are in here, by the way, Ray and I have had I've mentored him in the past. We've gone back and forth quite a few times. He likes to sometimes take trades that I strongly advise him not to take, but he's pretty strong-willed about what he wants to do. But in general, I've hopefully helped him over the last several years, even though he still struggles with certain things. But don't feel shy, or don't feel like I'm going to attack you on your trades. I'd like to see what you're looking at, and I usually try to find the positive of any trade that someone's in. So if you have something you want me to look at, feel free to type it in there. I'd love to see what the rest of you guys are looking at. Again, it doesn't have to be a trade you're taking. It could be just a question you have on a chart. If not, we can pretty much wrap it up here, and I can let you guys get back to your lunch or whatever it is you need to do. So Ray, you're saying CTXS is like, yeah, look at that. That's a really strong move. And again, not to say I don't think this is going to pull back. This is probably going to pull back, but it's hard to take that as a short because it's just, there's so much strength in it. Now, the one thing that is different about this compared to Apple is that this thing is coming up into resistance. Apple has no resistance. Apple's at new highs, right? So there is a little bit of a difference here. This one is coming up into resistance. It's stretched up into that. So, but even here, I think more than anything, I'd be looking more at taking profits if I was in it, not necessarily shorting it if I was not. But if I did short it, I still wouldn't do what you did. I'd still wait for, what you want to still see is hold on a second. All right, so what you still want to see is you want to see a top. You want to see something telling you that it's hit resistance. So, like in this particular case, and again, I would not, in this market, I'm not looking for shorts. But theoretically, if you wanted to short this, if you thought that this was reaching a level of resistance, and again, you can see it is coming up into resistance, right? But even then, you don't want to short it just because it's there. You want to see a reversal candle. You want to see signs of selling pressure before you get in. Now again, even if we saw those signs, the problem is because this is such a bullish move, once it pulled back, more likely than not, you're going to have buyers to step in that feel like they missed out on this move that are going to come in. So it comes back to that thing we were talking about before about the fear of missing out. There are a lot of traders right now that are they felt like they missed out on this move and they're chasing it higher. You have others that are like, oh, I'm going to be patient, but I'm going to buy it when it pulls back. But what they're going to do is they're going to buy it back in the first signs of selling. So even if you did short this, there's a chance that you're going to have to put up with this thing doing this. It's going to come down, and then it's going to come right back up, and then it might try to come down again, and then it might try to come back up again. And unless you had the right timing, unless you knew exactly what targets you're looking for, you might get stuck waiting for this thing, even if you were short and even if it did pull back, because there's so many buyers waiting to come in and try to buy what they think is still a strong stock moving higher. And you know, in all honesty, this thing still could break past that and continue climbing higher. But even if it did pull back, chances are it's going to consolidate around this level rather than just V-bottom or V-top and come right back down all the way down to the lows. It's probably going to spend a lot of time chopping back and forth, which would make it a very messy trade to take. And so that's why sometimes you avoid these trades, even if they look like they're setups you want. You have to try to analyze or think to yourself, well, if this does work in my favor, how's it going to work, and what am I looking for, and what's going to happen with it, you know? And you know, again, it's not to say that you shouldn't sometimes take these trades or take these counter trend trades. You just have to understand what your targets are and what the potential behavior of the traders involved in it are. Okay? Are you talking about gold futures? I don't know. I don't think so. I don't think it's ready to go down that low yet. So if you want to, it's basically the same as what we were looking at in with GLD, but I think in this case we can look at something like this, right? And I think it pulled back here. And what often happens when you have these breakdowns is you get this move first, which it's in the process of doing. And then if it fails there, then yeah, you get the next move down, right? But I think the next move down, I think this is a very critical level around 1420. And more likely than not, if it continues, it'll find support at 1420 before it heads down to 1400. Can it make it to 1400? Yeah, it probably could, but I think for it to get to 1400, we're going to have to see a major move back in the US dollar. And I don't know that the US dollar is really ready for that kind of a bullish move. So I think at the moment what I would look at is probably a potential bounce soon. And then as it comes back up to this level, then we have to figure out whether it's going to exceed it and get back into this wedge, or whether it's going to fail. And if it does fail, then maybe it heads back down. But I think even then, it heads down into this 1430 to 1420 range, not the 1400. I think 1400 is still a ways off, and probably not in the cards, at least not for the next few moves. And then if it does come to 1430, then we can see how it behaves there, and then try to figure out and assess whether 1400 is the next play. But yeah. Yeah, it's weird if the US dollar and gold rally together. That's usually not a good sign for the stock market, but I don't know that that's the case right now. Because if gold and silver, or if gold and the US dollar are up together, that means money is moving towards safety, which means it's moving away from risk, which means it's moving away from the stock market. I don't think that's really the case right now, but that is something that you tend to look at. I don't think that's really what's happening right now, though. I think that they're both, I mean, in the long term, they're both trying to rally, right? And that's kind of odd, right? So if you look at the UUP index and then you look at gold, then that, yeah, but the market is also doing well. So, you know, it's an interesting and tricky time right now to try to figure out what's going on. It's not that they used to be inverse, it's that they are inverse, but they're inverse correlations they're not necessarily 100% of the time. You know, it's kind of a thing where it's every now and then they sort of decouple, and then kind of trade together, or vice versa. And at the moment, we're in one of those spots where they're kind of doing something very similar, and I wish I had a better answer as to why they're doing it, but I don't. But yeah. Well, all right, Ray, and all right, everyone else that's here. Looks like no one else has anything that they wanted to add. If you had a chart request that you were too shy to ask in a public forum, you can always message me, whether you want to email me, stockdarts@gmail, or whether you want to, um, message me on Twitter, and I'll DM it to you or whatever you want. I'll be more than happy to give you any advice or any chart that you're looking at that way as well. Have a good rest of this week, guys, and we'll meet again next Wednesday.